Hi, welcome back. You're watching MF Corner. Now, we were to talk about the recovery in the equity market and what it means for your portfolio. But before that, I want to just, take a moment to talk about the numbers that we've got for September from, the collective of mutual funds, that's AMFI. And to my mind, actually, it's not looking too bad, even though there is about 1,000 crores in terms of a net outflow for equity funds overall. But that's largely driven by an outflow in multi-cap funds and some 500 odd crores in large cap funds. Ashish Shanker, Head of Investment Strategy at Motilal Oswal Private Wealth Management, is with us. Ashish, I think a lot of people would have redeemed the multi-cap investments in panic, unsure how the new rules would pan out or, where the resolution would finally be. But do you think this is money that's going to come back, and therefore equity is not looking too bad at all? I mean, barring the large cap space where, I think a lot more people are looking at the ETF strategy, you think sentiment is improving?
Yeah, hi Sumaira, always a pleasure to be on your show. Good afternoon to your viewers. Yes, you're right. See, equity flows, if you cut out the SIP number, have been negative now for 2-3 months. Last month, the regulation change would have also contributed to some redemptions happening in multi-cap funds. But I do believe sentiment is improving for equities as people are seeing businesses around them opening up. However, there is also apprehension at this point in time, Sumaira, because valuations have again recovered. Markets have almost shown a V-shaped recovery. And we yet don't see that kind of a V-shaped recovery in different pockets of the economy. So sentiment is definitely much improved. The kind of panic which existed few months back, the kind of frustration or fear which existed a few months back, that panic and fear is no longer there. But there is a fair amount of apprehension even today about deploying lump sum large investments into equity.
Okay, Ashish, let's talk about the equity portfolio overall, right, of investors, because there has been some recovery. Things are, at least looking up, even though we know that the pandemic is not yet over, but perhaps the worst is. I believe you have a proprietary way of sort of judging how allocation to equity should be done. Is that something that a retail investor could replicate?
Yes, absolutely, Sumaira, because what happens is that most retail investors get overwhelmed and consumed with all the noise around them. On one side, there is this entire noise about how the pandemic is panning out, how the unlock is happening. On the other side, you hear so many different nuggets of news flow from global markets that the investor gets confused as to how to invest his equity portfolio. Now, to cut the clutter and the noise, we have evolved a proprietary valuation framework called the temperature index. Now, this index takes into account very simple parameters to figure out whether the market is cheap, reasonably valued, or in the expensive zone. And depending on that, the investor can then take decisions on his portfolio. So the parameters that go into making this index are basically some of the equity valuation parameters like P/E ratio, price to book ratio, and dividend yield. Other than that, we also take into account interest rates. Because interest rates are a very important part of equity valuations. With interest rates at zero, you can't be valuing stocks the same way as if interest rates were at 4 or 5%. So we have developed this equity temperature index, and the range is between 65 and on the upside in the boom of 2007, it went all the way up to 135, right? So in this crash, it went all the way below 70. So in March, it clearly gave a buy signal and said that investing in equities is a no-brainer from a valuation point of view. As the markets have recovered, today we are closer to the 115 zone, which is the fairly valued zone, to getting a little bit on the expensive side.
Okay, what is this equity allocation and deployment grid? Let me just open it, pull it up over here for our investors to see. And Ashish, I know that it sounds fairly simple to you, but can you explain it in a language that we can understand? I mean, how does a retail investor make a temperature index? Or, is there a way that they could do it in a far simpler manner?
Right. So it's very simple, Sumaira. We use these equity parameters and interest rates, and we made it into one index, and we publish this index, every month in our research reports. Now, there are two things which matter for an investor. One is where the markets are in terms of valuations, and second, where the investor is in his journey of building his investment portfolio in equities. Right. So as an investor, I could be in three different zones. One, I am not fully deployed, which means I'm technically underweight. I'm fully deployed as per my risk profile. Or at times when the equity does extremely well, I am what you call overweight. I'm over deployed into equities. You could be in any three of these zones. But depending on where the markets are, it tells you how you should be reacting to equity markets. So I'll just give you one simple example which will, elucidate my point. So let's say you as an investor are underweight equities, which means you're not fully deployed and you still have to deploy your entire money. And the market is in the expensive zone. So the remaining portion of your equity you should deploy in a staggered manner. Similarly, if you're not deployed into equities and the markets are in the reasonable zone, the middle zone, you should deploy 50% lump sum and 50% in a staggered manner. Similarly, if you're fully deployed or over deployed into equities and the market is in an expensive zone, at that point in time, you should take out money in a staggered manner and rebalance it back to debt. So we've tried to make it a little simple for the investor, because otherwise, he gets overwhelmed by the noise and a lot of news flow that is thrown at him.
Okay, so you said currently we're in the zone where investment can be made?
Yes, we are in the reasonable zone to on the borderline of reasonable and expensive. And we believe that this is the stage where if you're fully deployed, then you should not be doing anything. You should basically let your investments be the way they are. If you still have to deploy your money, I think you can deploy 50% at this point in time, and the remaining portion you could do an SIP or an STP depending on what suits your current portfolio stance over the next 12 months.
Got it. Ashish, thanks very much for joining in and for explaining this so simply. With that, we're going to wind down then on MF Corner, but do stay tuned. The team of Closing Bell joins you next.